How advisors use one ETF as a core long-term portfolio holding. Grab something to write with, because the insights I'm covering today are the exact principles fiduciary advisors use to structure seven-figure portfolios. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. The question isn't whether you should use exchange-traded funds in your portfolio. The question is whether you understand the fundamental difference between building your wealth around an ETF versus simply owning one. That distinction represents the difference between strategic asset allocation and passive accumulation. For most investors, the portfolio they hold is a byproduct of random decisions made over years. For a fiduciary managing a seven-figure portfolio, the portfolio is an engineered system designed to withstand decades of market volatility while maximizing after-tax returns. When fiduciary advisors construct portfolios for high-net-worth clients, they are not simply selecting products off a shelf. They are architecting systems of capital allocation. Increasingly, that architecture begins with a single core ETF position that serves as the gravitational center around which every other investment orbits. This approach has become the gold standard of institutional quality wealth management because it addresses the structural flaws that cause most individual investors to underperform the broader market. Most investors understand diversification as a defensive concept, the don't put all your eggs in one basket mentality. But at the institutional level, diversification is an offensive strategy. It is a method for systematically capturing returns across multiple risk factors while maintaining precise control over your liquidity management. The core satellite approach solves a problem that most investors don't even realize they have: the collection problem. When you own 15, 20, or 30 individual stock positions or a handful of overlapping mutual funds, you don't actually have a portfolio. You have a collection, and collections are inherently unstable. They drift as different sectors rise and fall. They become concentrated in unexpected ways, often leaving you overexposed to a single industry without you realizing it. They generate massive tax inefficiencies and require a level of constant monitoring and rebalancing that most investors simply cannot execute consistently. A core holding changes the equation entirely. Think of it as the foundation of a building. It provides broad, stable, low-cost exposure to the market segment you want as your baseline. For many investors, this means a total market equity ETF or a broad-based index that captures the growth of the overall economy. This isn't the exciting part of your portfolio. It is the essential part. It provides the beta, the market return, that does the heavy lifting for your wealth over time. The satellite positions are where you express conviction. This is where you might tilt towards small-cap companies, value stocks, emerging markets, or specific sectors like technology or energy. But those satellites only make sense in the context of the core. Without that foundation, you aren't tilting, you are just guessing. By anchoring the portfolio with a massive core, you ensure that even if your specific bets in the satellites don't pay off immediately, the bulk of your wealth is still moving with the global economy. One of the most underestimated aspects of long-term investing is that tax efficiency is not just a nice-to-have feature. It is a performance driver that compounds over decades. When we are talking about core holdings that you plan to maintain for 20 or 30 years, the tax structure of your investment vehicle matters as much as the underlying assets. In the United States, ETFs have a massive structural advantage over mutual funds due to the way they handle redemptions. When a mutual fund investor wants to sell their shares, the fund manager often has to sell the underlying stocks to raise cash. This sale triggers capital gains. Because of the way mutual funds are regulated, those capital gains must be distributed to all shareholders, even those who didn't sell a single share. This means you could be hit with a tax bill for a fund that actually lost value during the year. ETFs utilize a heartbeat mechanism known as in-kind redemptions. When large institutional investors want to exit an ETF position, they don't receive cash. They receive a basket of the underlying stocks. This exchange is not a taxable event for the ETF. Consequently, the ETF can purge its lowest basis shares, the ones with the biggest built-up gains, without ever triggering a tax bill for the retail investor. What does this mean in practice for a high-volume market? A well-structured core ETF can sit in your taxable account for 30 years, appreciate by 500%, and generate almost zero annual capital gains distributions. You retain total control. You decide when to realize gains. You can use asset-based lending strategies against those shares for liquidity without selling. You can even use appreciated shares for charitable giving to eliminate capital gains taxes entirely. Consider the math. Two investors, each with $1 million, both earning 8% annually before taxes over 30 years. One investor pays 1% annually in tax drag from forced capital gains distributions and active trading. The other pays 0.2% through a tax-efficient core ETF approach. After 3 decades, the difference isn't marginal. It is hundreds of thousands of dollars in found money. That is the power of structural efficiency compounding over time. If tax efficiency is the silent return driver, expense ratios are the silent killer. The financial services industry has conditioned investors to accept fees that would be considered unconscionable in any other industry. We need to be very precise here. When you pay 1% annually to own an actively managed fund, you aren't paying 1% of your profits. You are paying 1% of your entire asset base every single year, regardless of whether the fund made money or lost it. On a $2 million portfolio, a 1% fee is $20,000 every single year. Over 30 years, assuming even modest growth, you are transferring nearly $1 million from your family's balance sheet to the asset managers. Core ETFs have fundamentally disrupted this model. You can now own a total market equity position for 3 basis points. That is 0.03%. On that same $2 million portfolio, your cost drops from $20,000 a year to $600. The difference, when reinvested, represents generational wealth. However, sophisticated advisors look beyond the explicit cost of the expense ratio. They also account for implicit costs. Bid-ask spreads, the cost of entering and exiting the position, tracking error, how closely the fund actually follows its index, securities lending revenue, whether the fund passes the money it makes from lending its stocks back to you. This is why institutional-grade advisors gravitate toward boring and massive ETFs for core positions. A fund with $100 billion in assets and millions of shares trading daily will have much tighter spreads than a niche, innovative fund. In the world of core holdings, scale is your best friend. One of the most vital advantages of the core satellite structure is how it enforces rebalancing discipline. Rebalancing is a systematic way to buy low and sell high without ever having to predict the future. Imagine your target is 70% core, broad market, and 30% satellites, high-growth sectors. If the stock market has a massive run-up in technology, your satellites might grow to represent 40% of your portfolio. Without a core to anchor against, you might feel lucky and decide to let it ride. This is how portfolios become dangerously top-heavy right before a crash. With a core position, the math is objective. You see that your satellites are 10% over their target. You trim the winners and move the money back into the core. Conversely, when the market crashes and your satellites lose value, you trim the core to buy the dip in your satellite positions. You are mechanically selling strength and buying weakness. Studies consistently show that the average investor's returns lag fund returns by 1% to 2% annually. This behavioral gap is caused by poor timing, buying after a run and selling in a panic. A rebalancing framework anchored to a core position doesn't eliminate the emotion of a market crash, but it provides a mechanical script that overrides it. It turns a scary emotional decision into a routine administrative task. In the U.S. market, the debate over the core holding usually comes down to the S&P 500 versus the total stock market. This is a foundational choice for your capital allocation strategy. The S&P 500 covers about 80% of the U.S. market. It focuses on the blue chips, the massive companies that dominate the global economy. The Total Market ETF covers 100%, including the small and mid-sized companies that have the potential to become the next giants. Advisors often prefer the S&P 500 as a core when they want to use satellites to specifically target small-cap value or mid-cap growth. This allows for more surgical control. If you want the simplest possible set it and forget it structure, the Total Market ETF is the answer because it inherently includes everything. The key is to pick one and stay the course. Switching between the two based on which one did better last year is a recipe for underperformance. A sophisticated portfolio must also consider the global bridge, how to handle markets outside the U.S., and how to handle the defensive side of the portfolio with bonds. Should international be part of your core or a satellite? There is no single answer, but there is a right framework. International markets often move in different cycles than the U.S. Over the last decade, the U.S. has been the clear winner. But in the decade prior, international markets led the way. Using a global market ETF as a core ensures you never miss a cycle. Alternatively, using a U.S. core with international satellites allows you to adjust your exposure based on currency strengths or regional valuations. For those focused on wealth preservation or income, a bond ETF serves as the core. The same rules apply: broad exposure, high liquidity, and low cost. Usually, this means an aggregate bond ETF that owns a mix of government and high-quality corporate debt. In the bond world, asset-based lending and interest rate sensitivity, duration, are the primary risks. If you need your money in 2 years, a long-term bond fund is a gamble, not a core holding. Professional advisors match the duration of the bond core to the client's actual cash flow needs. This is where do-it-yourself investors often struggle, as bond math is less intuitive than stock growth. How do you put this into practice? You start by defining your targets based on your specific life stage. Fund the core. Establish your 70% or 80% baseline in a broad market ETF. Define the satellite ranges. Allow your tilts, like emerging markets or tech, to fluctuate within bands, e.g. plus or minus 5%. Review quarterly. If a position stays within its band, do nothing. If it breaks the band, rebalance back to the target. Tax loss harvest. Throughout the year, look for opportunities in your satellites to sell losing positions to offset gains in other areas, then immediately replace them with a similar, but not identical, ETF to stay invested. This framework shifts your focus from what stock should I buy today to is my system functioning correctly? Summary: the path to generational wealth. The core satellite approach isn't a get-rich-quick scheme. It is a structural framework for solving the four horsemen of portfolio destruction: high costs, tax drag, emotional trading, and lack of discipline. Your core holding should be broad, massive, and incredibly cheap. It is the foundation that stays in place through bull markets, bear markets, and everything in between. Your satellites allow you to be creative, but they are always subservient to the core. The advantage of this institutional-grade approach is that it adds up. A 0.5% savings in fees here, a 1% savings in taxes there, and a 1.5% boost from disciplined rebalancing doesn't look like much in a single year. But compounded over 20 or 30 years, it is the difference between a comfortable retirement and a wealthy one. The financial services industry wants you to believe that investing is a complex mystery that requires constant, expensive intervention. It isn't. Own the market efficiently, keep your costs near zero, manage your taxes like a business, and let time do the heavy lifting. Keywords: core satellite architecture, tax optimization, liquidity management, asset-based lending, capital allocation, fiduciary duty, expense ratios, portfolio rebalancing, total market ETF, S&P 500, global bridge, behavioral governance. If you found this analysis valuable, subscribe for more institutional-grade insights on wealth management and portfolio construction. Like this video if it changed how you think about portfolio structure, and comment with your questions or the topics you'd like me to cover next. Disclaimer: this content is for educational purposes only and does not constitute financial, tax, or investment advice. Consult with a qualified professional before making any financial decisions. Would you like me to build a sample core satellite model for a specific age group or risk profile?